because what we want to do through these events is we want to educate. And that's always our goal. We always like to do, real estate investments education. And that's what all of these events are always going to be about. So the theme for this one is your future self is going to thank you. The last one was knowledge is power. Every event that we put on, there's always going to be a theme. Okay, so I'm Bawanka. This is Safraz. Our special guest from Equiton is Lawrence Raponi, and he's going to be sharing the most today. But like I said, what we always like to do is we like to bring value, and he's definitely going to bring a lot of value for you today. But one thing I also want to talk about is, like me and Safraz, we're the face of the Compass team. I'm sure you guys see us a lot. We're starting to expand. We just added Macario in the back. We just added him to our team, so he's been with us. Yes. He's doing good. He's been with us for 3 months now. He's actually just finishing his first training. But yeah, so you're gonna be seeing more faces. You'll be hearing from us as well. We also have Vanessa. Woo! Yes. So she's gonna be joining our team. I know some of you know her already, but yeah, she's doing her courses, and you might see other people joining our team in the near future. So if you can give them the same love and respect that you give us, we'll definitely appreciate it. So our goal with this, like I said, is always to just bring as much value as we can. Even for me, I remember when I first met Safraz and we were talking, and I never will forget when he told me 80 to 90% of millionaires and billionaires created their wealth through real estate. And right when I heard that, I knew, okay, I have to learn as much as I can about real estate. Of course, that led to becoming a real estate agent. And if we just keep it to ourselves, that's greedy. We gotta share with the people. So that's kind of what we're gonna be doing. So last time the bathrooms were right there. It was very easy. We actually had a flood. Things are gonna be a little bit more difficult today. So if you do need the bathroom, feel free to go out and down the stairs or down the elevator. You walk through the doors that you came in, and it's like 5 steps just straight forward. That's where the bathroom's gonna be. We've been having to use it all week. It's not the easiest, it's annoying, but that is what it is. But yeah, just for sure, really thankful that everybody is here. I'll bring up Safraz right now. He'll share a little bit with you. Actually, before I do that, what we're gonna be doing today, so after the events, we always talk to you guys and we find out what you thought about it. And the most common feedback is that we always get a lot from the Q&A. So what we're gonna be doing today, we're gonna keep this kind of presentation around 30 minutes. Throughout it, me and Safraz will kind of be directing, asking some questions. But if you guys do have any questions, you have paper, you have pen, if you could just write it down. And then at the end, what we wanna do is we wanna open it up to everybody. We want it to be a safe place. Any question is okay. There's no stupid questions. At the end of the day, we want you to be able to go home and think I have so much confidence in this. I know what I want to do, because that's probably one of the biggest reasons people don't make decisions is because they're uncertain. So the goal of this whole thing is that you have certainty, whether it's you don't want to do something, you do want to do something, you want to learn more about it. We just want you to have certainty. And then our book. So we always give a book, and me, Safra, some of our colleagues, we put it together. Basically what it does is it teaches you how to buy real estate, how to sell real estate, how to invest in real estate all on your own. You're probably wondering okay, why would you guys give this to us? You guys are real estate agents. But no, our goal always is to educate, because, when you know better, you do better. So I'm gonna pass it to Safraz, and he's gonna share a little bit with you.
Beautiful. Thank you, Blanca. Thank you guys for coming. We really appreciate it. Shout out to Blanca. So you guys know a little bit about my backstory when you've come to the other events. But as you guys know, I've invested in pre-construction. I'm a landlord. I've done flips. I've done whatever you can do in real estate. I've done it personally. So for me, a little story about how I started in real estate is kind of my backstory, right? I was in university and I learned that you could use your RRSPs to save money on your taxes or tax defer and then use it towards university, right? Every year you could put 10K, you could pull 10K out of your RSPs, save money on your taxes, and go that route. But you guys already know that there's the home buyers plan. So the home buyers plan, now it's 35K. When I was in university, it was a lot less. But the idea was with the university debt that I pulled out with my RSPs, you have to pay it back over 10 years. But with the home buyers plan, it's actually 15 years. So every year that I do my taxes, I'm like, oh, I have to pay back this 10% or whatever, the percentage is 7.5. And I'm like, why would I do that, right? When I was younger, I went to the banks and they said, oh, Safraz, you can invest it in high interest accounts or mutual funds. I was like, oh, what's the high interest accounts looking like? They're like, oh, like a solid 1%. I'm like, okay, 1% sounds enticing, you know? And or the mutual funds, right? You guys know how that goes. Many of you might, many of you don't, but there's so many fees involved, 2 to 3% that you have to pay to the bank. And many a times you leave in a couple of years, you don't get much out of it. So for me, I was like, how do I take my money and expand it? But I didn't know that you could utilize your RSPs, and now we have TFSAs, and now there's the new one that just came out with the home buyer saving plan. So there's many options, but I didn't know that you could kind of utilize it. So for me even, I was like, why not bring an expert on, right? Why not bring an expert on that can educate you guys on how to do it? And that's why we have Lawrence Raponi from Equiton, and he's actually going to take the floor and tell you guys all about it. Lawrence, the floor is yours.
I'm sitting here saying, who's this expert? This guy coming. Hi, everyone. My name is Lawrence Raponi. I'm the Associate Vice President at Equiton Capital. Today, we're going to be talking about some of the ways that, so unconventional ways, I'll say, that we can invest in real estate. Just by show of hands, pull the audience a bit. How many of you guys are here today to learn more about real estate investing? Nice. How many of you guys are here for the wine and the chips? Cool. Of the people with hands up, for the first question, not the second question, who's here to learn more about real estate investing? How many of you currently own a real estate investment, not a primary residence? Okay. So a lot of hands went up, said they're interested. A lot of hands did not go up when I asked you how many people have pulled the trigger. We're going to address today some of the major hurdles, some of the headwinds that a lot of you guys are faced with. Because it seems to me like a lot of you guys want to be involved in the real estate market or the investment space. But there's, in my experience, 3 major headwinds to do that. The biggest one that I encounter with my clients is down payments are a major obstacle. They're obtrusive, right? In the GTA, you need a down payment of what? 200K, 300K just to walk in the door. That's for a starter home. A duplex, even more. Triplex, sixplex, way, way more. The second major hurdle is financing, right? You may own your own primary residence. You may be fully levered on that. And that says nothing about 6% interest rates, which is a new phenomenon for 2022 and 2023. So let's say you've got that massive down payment and you can afford a 6.5% mortgage. Good for you. You're probably among like 3% of Canadians, but let's say that's you. Well, now, once you buy a property, you are inheriting a part-time job, right? You are now a landlord because in investing in real estate, particularly with buy and hold, you are taking on a part-time job. You're providing a service to your tenant, who is your client, which means you're beholden to them to fix the leaky dishwasher, to mow the lawn, salt the driveway, or whatever the case may be. Now, a lot of young and industrious people don't care about that. They say, bring it on. But what about the people that are approaching retirement? What about the single mother? What about the person with 3 kids at home who doesn't really want to go and shovel the driveway after work, right? So there needs to be a better way to invest in an asset class that we all know and like, right? And that's one of the solutions that me and my firm offer thousands and thousands of Canadians, okay? Before I talk more about our investments, who Equiton is, how we operate, I'll just say a few quick words about myself since you guys both gave pretty good bios and I want to jump in the pool too. I started investing in real estate at 23 years old. Pretty much I've been a real estate investor for most of my adult life. I turned 36 2 weeks ago. So I've been doing this for about 13 years, quick math. And I bought my first property as an undergraduate student in university. I went to Western, and me and 2 of my buddies, each went to our parents and asked the bank of mom and dad for 20 grand each. We bought a property in London, Ontario. It was a commercial truck insurance business for 420K, all in. Downtown zoning, fully urban zoning. It's 150 feet from City Hall. We converted this truck insurance business to a lodging house. We put 11 units in it. It's a 5,000 square foot, big old Victorian home. And I say it in one sentence, but the fact is it was the most difficult thing that I've ever done as an investor. And you're young, you're 24 years old, you're like, oh, what could go wrong? Like, we can do this. There's 3 of us, right? Just like us sitting up here today. And we're like, we'll do it. Nothing we can't do. Until you go to City Hall and file for a land use change and they stick you with all these fees and paperwork and we're standing there like, oh shit, what did we do? So I didn't know it then, but it actually changed the course of my life. And it repositioned my career trajectory into real estate. And so you guys are in real estate, I'm in real estate, but now I approach it through a bit of a different lens and I approach it as an investor, okay? So, like I said earlier, I work for a company called Equiton. And at Equiton, we are an alternative investment firm. And we give thousands of Canadians the opportunity to invest in real estate passively, okay? So it's a passive real estate investment for you. It's active for us because we're active real estate managers, but it's passive for the investor. Passive meaning you can participate in the appreciation of a building and in the cash flows that these buildings generate, just like you would if you bought a duplex and rented it out yourself, but you're not tasked with any of the ongoing day-to-day management of the building. You're leaving that to the professionals at Equiton who are doing this at scale across all of our buildings. And again, you're participating in the profits. And further to that, we are a private real estate investment firm. And that is critical to our success. It's the idea that we're a private firm. So back in the day, we used to be called private equity. I don't know what you guys know about private equity, but it used to be available only to the 1%ers of the world, right? Super wealthy people would be given these opportunities, usually by word of mouth, to participate in these types of ventures. But changes in legislation have actually come way down such that we can actually offer these investments to everyone. And that's exactly what we do. We like to think that we democratize the private investment space. I want to explain the benefits quickly of private equity before we even talk about our investments or returns or anything like that, because it's really crucial to our success. So I asked earlier who has a lot of any real estate investments. 1 or 2, put up your hands. By show of hands, how many of you guys own stocks or mutual funds? You must invest somewhere, right? There you go. A lot of people. Very common. That is what has simply been drilled down our throats by every financial analyst or money manager at every of the major banks, right? That's what we're told. Invest in your RSPs, get some S&P 500 ETF or some diversified investment, and you can retire at 65, maybe. What they don't say is that there's a lot of other ways to make money with this types of investments. Now, all of the investments like stocks, mutual funds, ETFs, these are all what we would consider in our industry publicly traded investments. They're public investments. All public investments, and this includes crypto, it's also a publicly traded asset, these share one common characteristic, and that is their value is actually determined by the market itself, right? And if you have a look at the stock market, you'll see that that is exactly how it behaves. The market of buyers and sellers determines the value of these investments, right? Amazon outperforms on earnings. All these traders come in and buy. Some algorithms go in and buy. Some pension funds go in and buy, and the price of Amazon stock goes up 10%, right? That's actually what we saw. I think they've reported earnings after hours today. They're up like 6%. And the same thing happens when they do terribly, right? They miss on earnings, things drop 5 or 6%. And then there's a ton of other market stimulus like COVID, like Russia's invasion of Ukraine, inflation, rising interest rates, the threat of recession. I can go on, and I won't. But my point is these things go up and down like a roller coaster, right? They're highly volatile assets. And that is my point. Public investments can be volatile. And volatility in my world is another way of measuring risk. Risk, volatility are two sides of the same coin. Private investments like Equitons and some others, on the other hand, don't work this way, okay? Because the value of an Equiton investment, as an example, isn't determined by this irrational market of buyers and sellers, right? It doesn't go up and down like a yo-yo because our investments are not traded publicly. You don't buy our investments on the stock exchange. When you make an investment at Equiton, you're doing so directly in the company. So it's like you walking to that bakery down the street and saying, buddy, every Sunday morning, I know there's a lineup outside of here after church. This is a profitable business. I want to give you 100K to buy 40%. So it's that type of privately held business. And because the value of our investments aren't publicly traded, they don't go up and down like a yo-yo. They are much more stable. And to that end, they behave much more closely to physical real estate, right? When you buy a bungalow, it's not going to go up and down like a yo-yo, right? I'm not going to say it never drops, but it's certainly more stable than a stock or an ETF or something like that. And that is what our investments resemble. They're much more stable and much more consistently performing. That is the benefit of a private investment, okay? Now, if you look at our history of results at Equiton, I can tell you that we've been doing this for about 8 years now. No investment at my company has ever dropped in value, period. It's never happened. Not in a single day, month, year, quarter. It's never happened. So the proof is in the pudding, as they say. These investments are very stable. The biggest hurdle I find for folks to invest is it's education. People don't even know that these things are available for them. And so I really appreciate doing events like this because not that all of you guys are going to turn around and be overnight investors, but at least you have an idea of what your options are. You're armed with tools that you now have in your toolbox as an investor to take responsibility for your own financial futures instead of relying on that high school graduate of a financial advisor at TD Bank who's telling you to put all your money in a high fee mutual fund, because that's bullshit. I'll tell you that right now. So who is Equiton? That was my long-winded introduction, but more concise. We are a private and passive real estate investment firm, okay? And I talked about what being passive was. I talked about what being private is. Now, at Equiton, we are what I would call a fully integrated real estate firm. And that's just a fancy way of saying that we are unique because we do all of our own asset management in-house. So when we go out and buy properties on behalf of our clients, we do our own property management. When we launch a development investment, which we'll talk about later, we are the developer. So Equiton Capital is raising the capital. Equiton Developments is building the condo, as an example. And because we do everything in-house, it gives us increased control over our assets, but it also reduces costs, for our investors. Okay, so it's part of our value proposition. In terms of how our investments work, we have 3 different investments at Equiton. And if you guys care to now or later, in the folder I provided you guys, there's an investment overview. You can check now or later, doesn't matter, but there are 3 investments. 2 of the 3 are funds. So we have funds that we run at Equiton, and a fund is similar to what you can think of as a mutual fund, right? It's a basket of real estate assets. So when you make an investment in the fund, you are purchasing ownership in the entire portfolio of investments. So think of the fund as a company. It goes out and buys, let's say, apartment buildings. And so as an investor in this fund, you share in the profitability of all 50 apartment buildings and in the cash flow that these buildings generate. Now, think about that for a second, because there's a lot of implications to what I just said. Number one, you are getting instant diversification with your investment, right? You're putting in a small investment amount, could be as low as $10,000 in this particular fund, and you're getting exposure to 32 or 50 or 60, whatever it may be, different buildings. Not something you can do yourself when you go and buy a property, unless you're buying 6 properties at one time, in which case you should probably be up here giving a speech, and I should probably be in your seat. The second benefit is that, again, it's passive for you. You're relying on the experts at Equiton to manage these buildings professionally and at scale, because we manage more than one building. And because we manage at scale, we can reduce costs in ways that an individual, like me, when I run my 12-unit house in London, I just can't match that, right? Because when my company goes out and buys a bunch of high-efficiency light bulbs and toilets, we don't buy 4, we buy 400, right? And because it is so diversified, you're protected against risk. And that goes to why our investments have never really dropped in value. But here's the genius part about Equiton and our investments. It is how the investments are valued. So earlier I made a comment about how Equiton, we're a privately held firm. Because we're privately held, the value of our investments isn't determined by the market of stock traders, right? Well, in the Q&A, one of you smart Alex might put up your hand and say, well, then what determines the value of your investments? You're saying it's not valued by the market itself. So what dictates whether or not your Equiton investments go up or down? It's a very good question. The secret sauce to Equiton is that there's only one thing that impacts the value of our investments, and that is the third-party appraisals that we do on the buildings in our portfolio. Based on third-party appraisals, we set the unit price of our fund, and that's what leads to the stability of the fund, okay? So that very high-level architecture describes those 2 funds. Now, one other thing I'll say about the funds is that they're both cash flow producing. So if you're the type of investor that wants routine monthly income, say as if a tenant was paying you monthly rent, it's kind of the same, you're going to be at home in either of our funds because both funds produce a very, very healthy monthly income. They both pay 6% annually, distributed monthly. Okay. Now, forget about the funds for 1 sec. Let's talk about the third investment on that sheet of paper. It is the one on the far right. It is the one that targets annual returns of 20% a year. It's a monster of a development. It's very attractive, albeit a little risky. And it is an investment in land development. Okay, so this is fundamentally different from our long-term buy and hold approach on our funds. We are in this development investment, we are physically constructing a building for the purposes of selling it on completion. Okay, so we're not putting tenants in this thing. We're doing something like building a subdivision. We're selling off all the houses one by one, or we're building a condo and we're selling off all the units one by one. Think of any condo, look at the nearest crane and wonder how that building's being financed. It's being financed by companies like us. Okay, so our investors can now participate in the development of these buildings. You are truly the first person in on a condo development, which is kind of a misnomer. A lot of realtors, I'm sorry guys, will say, buy this pre-construction condo, you're the first one in the door, you're going to make the most amount of profit. You're not the first person in. Your purchase as a pre-construction investor is our exit strategy. So we're selling pre-construction and we're leaving with our returns. And then hopefully a pre-construction investor can do the same thing. But really, we're the first persons in because we're building the damn thing. And our investors can participate at that early stage as well. Now, these development investments, they're different from the funds completely. Number one, they're not diversified. When you're doing a development investment, you are investing directly into one condo being built in a certain area, in a certain location, at a certain stage in the market cycle, right? Building a condo today is much different from building a condo in 1995, even if it's on the exact same plot of land, right? The second thing to know about the devs is that they're not cash flow producing. And that should make intuitive sense to you, right? If you're building a condo, at what point are you paying out routine cash flows? You're not. In fact, it's the opposite. These investments cost money. They don't make money until the end. And that is actually when your profits are paid out. So we're going to be physically constructing a building. We're going to be selling off all units one by one. And we're going to build the asset until occupancy is achieved. And that's when the building is registered with the municipality. We can hand over the keys to the end user or investor. The full amount of their deposit is now due. And that is the profit that goes all the way back to investors at day one. Could be 5, 6, sometimes even 7 years later, depending on the size and scope of the project. Which leads me to my next point. These are long-term investments, right? You don't just walk into a development and then 6 months later say, oh, I'm good, I want my return now, all my 20%. That's not how it works. They're fully illiquid. So once you make a development investment, you can't decide 4 years into a 7-year project, you want your money back because your money's been spent. We hired construction workers, crane operators, cement pourers, et cetera, et cetera. So you're in it until it's done, hate it or love it. Now, for all the reasons I just mentioned, can be pretty risky investments, but you can also double your money every 5 years, okay? So the idea at Equiton is that depending on your propensity towards risk, depending on your age, your demographic, your financial strategy, we have an investment that fits your profile as an investor, from very low risk, very conservative, very cash flowing investments to more higher risk, higher growth investments. Now, the kicker, and this applies to all of our investments, is that you can use registered accounts. These investments operate much more closely to that of a stock than they do that of a physical piece of real estate. And I say that because you can use a TFSA, you can use an RRSP. If you have a LIRA from some previous employer that you left 7 years ago and it's kind of just sitting in some segregated fund at Sun Life Financial or some mutual fund, we can use those funds too, right? In fact, the nicest thing about our investments, and this particularly applies to the developments, is that they play really nicely with RRSPs and TFSAs, because an RRSP is a long-term account. I can see how old the average age of you guys in the audience, probably mid to late 30s, my age. You got a lot of time on your hands. You can't touch that money until you turn 65, right? You might as well have that thing triple on you, or 5x or 4x, right? And so there's a natural fit between the types of investments we can offer clients and the mechanics of a tax-exempt vehicle like an RRSP. I don't think I want to go into too much more depth. I'll leave it to you guys to maybe ask a few questions first, and then we'll pitch it to the audience.
Yeah. I mean, thank you for that.
You're welcome. I wasn't sure when I should stop, but I was like, now's a good time.
that was really good. I know you were talking about, like, a lot of people don't know about something like this, and And even me and Safraz, we've talked to like a lot of even real estate agents who were not even aware of something like this, and like this is the industry that we work in. So I think it is really good that we're able to kind of find out and learn about it. But I know you said it's kind of there's all different options for people, and you have to wait to kind of exit. So maybe if you can give us an example of what like high risk looks like
Mhm.
compared to like a low risk.
For sure. So definitely in terms of the investments we offer, the developments are going to be by far the highest risk investment. Um, you need to understand though what I mean when I say high risk. It's high risk relative to some of our other investments. And again, I've said this at the beginning, but I'll repeat it. No investment at Equiton has ever dropped in value. Period. Never happened. So when I say high risk, I'm not saying, oh, you're going to put in 25 grand, but you might only get back 10 grand, right? This isn't cryptocurrency. This isn't Bitcoin. What we're trying to say is that your returns may not pan out as is, right? So I'll give you an example of our current development. We are building a 12-story condo in the Scarborough Bluffs neighborhood, east end of Toronto. It is a 5.3-year term project. The total ROI on this project, 106.6%. So if everything goes according to target, all of our investors will just slightly over double their money. Now, that return may shift upwards or downwards, right? We may be able to build for a lower cost than we forecasted. We may be able to sell units at a higher price per square foot than forecasted. So that price target can fluctuate, but the time commitment can fluctuate. We're foreseeing 5.3 years. What if we get delayed 7 months, right? What if we finish ahead of schedule 4 months, right? You as the investor are assuming that risk. So in that sense, it can be a risky investment because a 5.5-year project can turn to a 6-year project like that. If you guys have ever bought a pre-construction condo and it was delayed 6 months, surprise, surprise, happens a lot, particularly in GTA-based developments. Very, very common. On the lower end of our risk spectrum is our residential fund. It's the one that would be analogous to you buying and holding your own residential property, putting in your own tenants, renting it out yourself. That's the strategy that I employ. I think it's probably Safraz, the one that you employ as well, with our own investments. And that's what this fund would do, just in a much more flexible form factor. This thing is very, very consistent, very, very low risk, but the returns are lower as well, right? Lower risk, lower return. That's how things work. So the developments target annual returns upwards 20%. On the lower end of the spectrum, the residential fund targeting returns of 8 to 12% a year. And there's some cash flow embedded in that.
Okay, so I would say, again, like, what would you say like some of the like lower returns that you've seen are, and then on the high end, what are some of the higher returns that you've seen?
So in the residential fund, we'll just use that as an example. We've done as low as about, I want to say 6%. I don't want to misquote myself because you guys all have fun fact sheets ahead in front of you, which have the historic returns on it. In our earlier years, we didn't do as well. So I think it was 2017, 2016, we didn't do very well. And largely because when you're building a fund like ours, there's a lot of upfront expense, right? You don't just open a company like Equiton's and hire a compliance department and finance and audit and marketing without absorbing a lot of upfront costs, right? It's like starting your own real estate brokerage firm. First 2-3 years, probably not going to be profitable. Your next 15 years, much, much better. And we, because we're a privately held company, follow a very similar business trajectory. Last year was our best year on record. So this would be an example of the high end. 14% annual return. And that was in a year where the S&P 500 down 18%. Toronto Stock Exchange down about 13, if I'm not mistaken. Even real estate, physical real estate, was down last year. So we had a killer year. And that's why it's important, I think, whether you do it at Equiton, folks, or otherwise, whether you go to another firm, I don't really care. But it's important that investors have exposure to alternative investments. The reason why is because of their uncorrelation with the stock market. So when you see markets or years like 2022, where every investment pretty much kind of shit the bed, you can have a piece of your portfolio in something that's not going to just continue to degrade, right? And that's worth something. It is to me anyway.
Okay. Yeah, let's open up the room. Like I said in the beginning, there's no bad questions, there's no wrong questions. Like this is it's a safe space. You can ask anything. At the end of the day, the goal is that you understand this investment before you get to leave. So
Yeah. It's all about education.
yeah,
Right.
what does anybody have any questions? Z?
So your fund, you obviously built it during a real estate environment or an interest rate environment that was very favorable.
Extremely favorable.
Yeah, and it's a great time to raise capital. Well done. But I wanted to know from your perspective, if you play out the next 5 to 10 years, if interest rates, let's not say go higher, but stay roughly around here, how does that impact your business?
Yeah, that's it's a super common question. Everyone asks that question now. Even existing investors will call me and say, "What's going on with interest rates? What's your outlook?" First of all, I'll tell you our outlook. We don't think interest rates are going up another inch from here, but we also don't think they're falling. People seem to think that by Q3 or Q4, the Bank of Canada is going to cut rates. I'm here to tell you that they're not, and if they do, it's not good. It's probably because the economy is gone like that. So, and that's not good because that means unemployment has started to increase, vacancies have started to increase. So we're hoping for stability. Now, in terms of how that affects us, it doesn't affect us very much. And I'll explain why. Every firm that operates in our space, and there's not a lot of us, but there are a few, we all operate a little differently. At Equiton, we are very naturally risk averse. So there are some other firms out there that will give you higher returns, but they're going to have more variability, more volatility. At Equiton, we pride ourselves in having low volatility. How do we do this? We manage risk. One risk that we manage, interest rate risk. It's huge for us. Obviously, when you buy a $50 million apartment building, you don't pay cash for it, right? It's leveraged. So I'll tell you that as a rule at Equiton, when we underwrite a mortgage, we do so on a 10-year fixed basis. Every single mortgage we have is a 10-year fixed. Now, some mortgages that we have, we've actually inherited with buildings, and we will accept an inherited mortgage if it is such a favorable product that it would be terrible for us to turn it down. For instance, if someone had locked in a 2.5% mortgage and it's good for the next 7 years, well, I'm not going to cancel that mortgage and replace it with a 10-year fixed at 7%, right? In fact, I'll probably pay extra for that building to get that very attractive financing rate, because when you're buying an institutional grade piece of real estate, the mortgage stays with the property, right? When you buy a house, the mortgage leaves with the person, right? No one else can assume your mortgage with the same terms. When you buy a $50 million apartment building, that's not how it works. The mortgage sits on the property. So we might actually overpay for a building with more favorable rates. But I'm running in circles now. My point is, when we underwrite a mortgage, we do so on a 10-year fixed rate. We've been doing this since we started our company. And people would call us perplexed, being like, why are you paying 4.5% when you can pay 2.8? And we do that for macroeconomic climates like today, characterized by rapidly rising interest rates. Do you guys remember when the Bank of Canada and the Federal Reserve said inflation was transitory? Remember that word, transitory? And how silly that was? Everyone thought this was going to be short term. And we said, no, we're just going to keep doing what we do. And that's actually why we had a 14% return last year. Because in inflationary environments, in markets characterized by rapidly rising inflation and interest rates, generally speaking, you see carrying costs of real estate rise, which acts as a downward movement with real estate, yes, but it also pumps up the rental market. And the reason why is because the barriers to entry into the housing market for ownership are now higher, right? If me and my fiance are we're renting currently, we're potentially looking at buying a 1-bedroom condo. Well, that mortgage payment that used to be $950 a month is now $2,000, right? So what am I going to do? Probably just going to stay in my condo or my rental situation for another year and wait it out. After all, inflation's transitory, right? That's what the Bank of Canada told me. So what we saw was a far greater increase in demand for residential real estate rental, right? Which boded well for us. But we didn't see that same commensurate increase in interest expense. Our carrying costs didn't move because of our mortgage structure. And that's why we performed as well as we did.
Jamie.
So do we have to wait for you guys to be ready for a project, or is it something that we can just go in stream at any point?
Awesome question. So let's talk about our two funds for a second. The two funds are open-ended funds. They're always open. They're always operating. As we raise more and more capital and we have excess capital, we grow the fund. We go out and acquire more assets, right? That's how we've gotten the fund to 32 buildings. Started with 1, 2, 3, 4, so on and so forth. The developments are a little different. Developments are somewhat limited time opportunities because when you're building a condo, you only need a certain amount of equity capital. So for our building, the building in question, we're building that 12-story condo in Scarborough. We need $38.75 million of equity capital. Now, the reality is we probably need 270 million. The rest will be borrowed, of course, but we need 38 million of equity capital. Once we raise 38 million, the investment closes. No money comes in or out, and the investment proceeds. And if you call me up and say, oh, I finally sold those mutual funds you told me to, Lawrence, I'm ready to proceed with the Sandstones project, that's the name of the condo, I'd say, sorry, man, it's full, it's fully allocated. We'll launch another one in 6 to 7 months. And that's generally what we're doing. We're probably doing I'd say maybe 3 developments a year, 2 to 3 a year.
Okay.
So if you miss the bus on one, there will be another one, but it's not going to be right away.
And then for your other portfolios that you can invest into, are those ones a little bit more
Yep,
fluid?
they're open-ended, so you can invest at any time. Because as I said, if we can accept more capital, and when we do so, we'll just buy more buildings. So we can put that extra capital to work very quickly, right? You have to understand that when you give us your money, you're giving us your money under the expectation of a return. So I need to put that money to work. It just can't sit in our checking account burning a hole in our pockets because I need to pay you. So it behooves us to put that money to work and buy more buildings. Yeah.
I got 2 questions.
Sure.
So one being, how often do you appraise your property? I'll let you answer that first.
Okay. We'll talk about appraisals generally speaking, and this applies to both of our funds, okay? It's a common characteristic of both of our funds. Our buildings are appraised quarterly. So we do 4 appraisals a year, and they are done by a third party. We use a company called CBRE. Any real estate agents in this market will probably know who CBRE is, multinational real estate firm. They do many services. One of the services they do is real estate appraisals. So they will come in, they will tell us what our buildings are worth. Based on the outcome of these appraisals, we set the unit price of our fund, okay? There's a reason why we use a third party. There's a reason why we don't set our own prices. And the reason is conflict of interest, right? I have a vested interest in my buildings being worth $20 trillion, right? Because then I can sit here and say, we manage $30 trillion of properties, blah, 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 and it sounds great. Everyone makes money. So we hire a third party to come in to eliminate even the idea of a conflict of interest. They have no skin in the game. Their responsibility is to you, the investor, right? They're being paid for a service, and that's what they're delivering. Based on the outcome of these appraisals, we set the unit price of the fund. So as an example, in our residential fund, we have 32 buildings. So in the month of April, it's April month end, this weekend, we might have done 15 building appraisals this month. Of the 15, 7 came back flat, 1 came back down, and the other, I can't even do the math on that, the other 7 came back up. Maybe we renovated some units, we turned over some tenants, we fixed that leaky roof, and then we put in a couple of penthouse units. We put in some more efficient appliances. There's lots of ways to maximize value on a building. And so the net effect is upward, so we'll raise the unit price of the fund, commensurate with the aggregate increase in value of this 15 appraisals. And that's how it works.
And then
Next question,
and then
sorry.
The second part, a little more technical, but I guess your dividends or whatever is paid out based on your net profit. And so are your books open? Like, what's to stop you guys, if you have
Yes.
a great year of 20%, giving yourself a bonus of 5?
So all of our compensation is disclosed up front, and all of our financial statements are audited by Grant Thornton. They're an accounting and consulting firm, and they are posted publicly. So they're not only available on our website, which they are, you can go to our website, but we actually file them with the Ontario Securities Commission. So when you are, what's a big Canadian tech company? Shopify. There is a platform called CDAR, where if you're a publicly traded company, you have to register your quarterly earnings reports, your audited financial statements, so on and so forth. We register our reports on the very same system, okay? So we are a company in good standing. The fact that this is a common misnomer. The fact that we are a privately held company does not mean we're not regulated. It just means we're not regulated to the same level of scrutiny as is a publicly traded company. It doesn't mean this is the Wild West and I can sell you, I don't know, like an igloo or something ridiculous, right? It's not really how it works. So there are checks and balances in place at the firm level and even at the individual level. I'm licensed. My name goes on every investment I do. So if I ever gave someone an investment that was not prudent for them and you filed a complaint with the Ontario Securities Commission, I'm not going to lose my job. I'm going to lose my career because I'll be unemployable after that. So please don't do that. Okay? but truthfully, I have a fiduciary duty, as does my firm, to our investors, right? And we work hard to keep that as tight as possible. Any other questions? Yes, sir.
Charles.
At Equitone, is there a specific real estate asset class that you guys are extremely bullish on? Being affordable housing, multifamily development? Is it something that you guys are looking at and trying to be super aggressive? And if so, why that specific asset?
Yeah. I'll say two things. The first one's going to be obvious. The second one, you're going to look at me sideways a bit. First one's multifam residential rental real estate, higher density residential specifically. Our thesis is simple. There is a drastic discrepancy between supply and demand for residential real estate. We have a liberal government, whereby they're mandating to let in 1.5 million new immigrants in the next 3 years, I think, 500,000 a year. There's nowhere for these people to live, honestly. There's nowhere for these people to live. We can barely satisfy our own organic growth, let alone accommodate all of these people. The people that are coming in, we would like to think they're all surgeons and doctors and lawyers and engineers, but a lot of them are going to be relegated to the rental market for the first, let's say, 5 to 7 years that they're here. And I'll say it again, there's no place for these people to live. So very bullish in the immediate and medium term for higher density residential real estate, whether it's a condo, apartment building, duplex, even subdivisions. I'm bullish on all of it. My second point, I would say commercial real estate. And the reason why is, and this isn't now, I would never run out and say, oh yeah, office towers are coming back in vogue in 6 months, it's going to be great. They're not. But when we buy real estate, and this is a lesson for all of you guys as well, we're not speculators. We don't flip properties. We've actually never sold a property at Equiton. It's never happened. It's not part of our investment thesis. So when we buy a property, we're doing so on a minimum pro forma of 10 years, a decade. So do I think that commercial real estate poses opportunities in the next decade? Yes. Do I think there's going to be a return to normalcy? Yes. Do I think people are going to work from home forever? No, I don't. So, and I think that there's a lot of opportunity there because I think it's very mispriced. Particularly if, for instance, we retract the green belt and expand the urban boundary out there. Well, now we need new plazas. We need schools. We need movie theaters. We need churches. There's lots of opportunity to invest in commercial real estate in maybe more unconventional ways. I'm not saying run out to downtown Queen Street and buy a storefront, right? But there's lots of opportunities out there in this asset class if you care to look.
Okay. I want you to talk to somebody who's newer to real estate. They heard, okay, you only have to put down $5,000 to get into real estate.
Yeah, I actually should have talked about that.
Yeah, no, for sure. But you talked about there's 2 funds that are already open, but you also talked about you're tied in for 5 years or 6 years. Was that just only with certain developments, or is that in the open fund as well?
So let's talk about the holding period. Everything in the investment space or in life really involves trade-off, right? I'm sitting up here and I'm telling you guys that I can offer you an investment that's never dropped in value. That's essentially what I'm telling you. And your answer to me should be, what's the catch? Because in order to get that, you're probably going to have to give something up. And you do. What you're giving up is time, okay? These investments, they're flexible like that of a stock. You can hold them in RSP accounts. You can invest with very small amounts. But they actually operate much more analogously in some ways to physical real estate. And the reason why is because when you invest with us, we take that money and go and buy physical real estate. That's really what we're doing, right? Now, I told you earlier, we're long-term investors. We've never sold a property. Every asset we buy is done so on a minimum of a 10-year pro forma. We need our investors to have the same long-term investment mindset and timeline that we do when we put your capital to use. And to that end, we do have minimum holding periods on our investments. Now, they're not 7, 8, 9 years or 5, 6, 7 years. They're 3 years. Okay, so our 2 funds have a soft holding period of 3 years. And I mentioned this already, but with our developments, when you're in on a project, you're in until it's done. So if it's a 7-year project, it's a 7-year project. If it's a 9-year project, it's a 9-year project, right? And you're compensated for that commitment, some very nice returns. But the fund's much, much more flexible. Now, in addition to it only being a 3-year hold, they're what we call a soft holding period. And I'm going to explain what that is because you guys are probably like, what the hell is he saying? A soft holding period is one whereby you can sell your investment, you can redeem it at any time. You can make an investment today, you can call me in 7 months and say, Lawrence, it's family emergency, or my kid got into Harvard, but tuition's $100K, I need that money back. And we'll honor a redemption. However, if you redeem before the 3-year mark, there are early redemption fees to be paid. Okay, so that is how we incentivize our clients to stay invested.
What
This
do the fees look like?
So if you redeem in the first year and a half, they're different between the residential fund and our second fund, the income and development. We'll talk about the res fund. If you redeem in the first year and a half, it is 3.5% of your investment. If you redeem in the second year and a half of the 3-year period, it's 3%. Yeah, pretty sure I got that right. Now, I want to say one thing about the fees. They're not a source of profit for us. It's not how we make our money. We don't want to charge these fees. We use the fees to incentivize a 3-year commitment. I cannot stress that enough. We want your time. We don't want your money. But you need to understand that when people move in and out of our fund, like they're day trading Tesla stock, it poses a risk to our other 10,000 investors, right? I'll give you an example. Let's say you come to me and you say, Lawrence, I heard what you said at the talk. I love the residential fund. I want to give you $1 million, right? And I go, that's amazing. So you give me $1 million. What do I do with that money? I'm going to put that $1 million as a down payment on the acquisition of an apartment building. So if you came back to me in 7 months and said, Larry, I need that $1 million back. And I'm going to say, well, I don't have your $1 million. I have a 35-story apartment building that I purchased in Kingston, but I don't have your $1 million. And that's a problem, because now the only way I can make you whole again is by taking from Peter to pay Paul. So taking other people's investments and giving them back to you, which is not a good model for success, by the way. Or I have to sell an asset. Well, what if we're in a down market characterized by rising interest rates? What if I don't want to sell an asset, right? So now I'm in a situation where the only way I can make you whole is by making all my other investors worse off. We don't do that. So we try to impart procedures that avoid that situation. Mm-hmm. Yes?
Can you guys speak to some commercial investments that you guys have done?
For sure. In our space, commercial means it's a catch-all phrase for pretty much every asset class. At the institutional level, even an apartment building is commercial, technically speaking. Our latest acquisition is actually on the Income and Development Fund's fact sheet. It's a 2.68 acre commercial plaza in London, Ontario. Massive property, 12 tenants, and it's anchored by 2 fantastic tenants. One's the CIBC, Schedule 1 chartered bank, and one's a Wendy's, the burger joint. So these are the types of properties we're buying. They're generally in more suburban areas as opposed to downtown urban commercial properties. We're not buying 15-foot wide King Street West commercial properties, for instance. And generally, when we're buying these properties, we're targeting properties with potential for anchor tenants. Do you guys know what anchor tenants are? Do you know what anchor? Perfect. So we want anchor tenants, of course, because not only do they drive consumers to your property, they drive other tenants to your property.
Can you touch on the anchor tenants for the people who don't
know?
So
an anchor tenant, this applies to commercial real estate, doesn't apply to residential, but anchor tenants are, generally speaking, very large, very stable businesses, right? Think of Walmart, Costco, Harvey's, Wendy's, McDonald's, any of the major banks. In Canada, a big one, LCBO and Beer Store. Great anchor tenant. They're borderline a crown corporation, right? Very protected industry. But these tenants, they serve many purposes. The first one is when you sign up a tenant like that on a lease, they're very long-term leases. Costco doesn't sign a 3-year lease with you. So you're guaranteeing yourself cash flow for the foreseeable future. Now, inclusive on that lease is going to be what we call a rent escalation clause. So you're going to be able to bump up rent in a very predictable and safe manner, because if you're leasing to Costco, you know they're paying rent on time, they're paying it in full, you don't have to chase them around for rent. That's not how it works. So it's much more, when you have tenants, when your vacancy is low, the risk is lower. Now, vacancy is a much more drawn out process, and I want to go into that because there's a whole separate talk we can give on commercial. But that's one of the benefits of anchor tenants. The second is people want to be, they're driven to these properties because of these tenants, right? You're going to go to the plaza with a Costco in it, but while you're there, you might stop off at the nail salon. You might stop off at that fresh produce place that just opened up next door. You might get your tire fixed, whatever the case may be. So that leads me to my next point, which is if you're an accompanying business, a complementary business, you actually want to be beside that anchor tenant, right? Because it bodes well for you. Classic examples of that are open up a car wash beside a car dealership. Open up a pharmacy next door to a medical clinic or a hospital. Open up, oh, this one's a good one. Open up a weed store next to a McDonald's. Right? Right? It sounds silly, but if you were actually opening a weed store, would you not consider that as potentially strategic advantage for you? The answer is yes. So that's why anchor tenants are useful. Yes.
You guys handle all the leasing yourselves?
Everything is done in-house. So there are three prongs to Equiton. There's Equiton Capital Partners, which is my employer. We have Equiton Living, which is our property management division. All of our commercial and residential properties are managed 100% internally. We outsource no property management to anyone else. And Equiton Developments does our developments. Everything's handled internally.
Speaking to the development fund, where is the most recent condos that you guys have for the land that you purchased for the?
So this one is at 2257 Kingston Road. It's in an area called Cliffside. It's a 4-minute drive from the Scarborough Bluffs.
And what, are they all in the GTA or do you go outside the campus?
So all of our developments are in the GTA. Our what's in this area is our farthest one. Guelph would be our furthest one. So nothing too far, again, because we do them ourselves and our headquarters is in the GTA. We don't want to necessarily start a project in like BC. Actually, that's not true. I just remembered we're doing a 3-tower master planned apartment complex in Ottawa. Okay? And that development is actually located inside the residential fund. So it's not a standalone investment. It only exists, we'll say, in the residential fund.
I assume this one is open right now.
Both of our funds are, and yes, Sandstones is currently open. I would say we're at about 65% capital raised. We're at about 27 million, 28 million, I think. So, yeah, still some space. Yes.
So for your fund, what are the minimum investments for?
Yes, thank you for
the
reminding me.
fund or the development side, and then also, have you completed any development process?
Yes,
Because
we
you
actually
said-
completed a development, I'd say last week. So we're paying it out in the next, 30 to 60 days.
And how long did
And
that
this
take?
it went over budget, over budget. Did not go over budget. It went over timeline by 1 quarter, which in the development world is on time. So, yeah, that's on time. Like, our development team is high-fiving each other. It's only been delayed 4 months. And your first question was about the investment minimums, and I thank you for raising it. I should have mentioned this at the beginning. I told you guys earlier how a huge impediment to investing in real estate is the massive down payment that's required to buy even a 1-bedroom condo. Equiton serves to address this issue because of how low our minimums are. So if you have that sheet open in front of you from left to right, our investments, the minimums are 10,000 on the left, the residential fund, 5,000 in the middle, so it's our lowest and most approachable fund, and the minimum for the developments is 25,000. It's our highest minimum, but even then, not that obtrusive. Again, a far, far cry from something like a $200,000 down payment. It's very approachable, and even with that 5K, you're getting instant diversification across multiple assets. You're not pushing all in on one project. Yes?
You keep referencing the residential fund, 'cause I just don't, and maybe I'm the only one, am I missing the wrong page? Is it the apartment fund or are you talking about the
Yes.
development?
So
operating?
the residential fund and the apartment fund are the exact same
Exact
thing.
same thing,
Yes.
okay, and that's the 10K.
The minimum is 10K.
Okay. So can you go through just the 10K and then what's the middle?
So the apartment fund / residential fund is a 10K minimum.
Yep.
The middle fund is the income and development fund, and it's 5K. And the development is Sandstones. It's our Scarborough-based condo, 25K.
Perfect, thank you.
And what's the time frame for the development fund?
5 and 1/3 years, 5 years and 4 months. And we started it, we say, as of January 1st of this year, because technically we submitted our application with the city Q4 of 2022. So the project's already ongoing.
So Lawrence, I actually have a question.
Yes.
So like, as realtors, we get a lot of questions like, we know a lot of realtors that have been in the business for 10 years, 20 years, and many of them do like 1 to 2 deals here and there. So that's a question we get. So for you, my question is, how much assets do you
Oh, man.
manage financially?
We manage just shy of $1 billion under management. I was going to say yesterday. Last year, we bought 7 properties. Average value was $50 million. So, yeah, do the math. We started this company with 3 employees, $1 million of equity capital, which is honestly like 3 people can put that together in 2023. Kind of sad. This is 2015. And yeah, bought 1 property, 3-story apartment building, which we still own in the residential fund in Stratford. Not a nice building, if I'm being honest. Fast forward to today, just under $1 billion in management, 165 employees. I myself manage a team of about 15. So just exponential growth. We've literally doubled in size every single year we've been in existence. I think the only year we didn't was last year. You can't keep doubling after all.
Yeah.
You have
And
to
what
stop
was-
eventually.
When did you guys start?
2015.
2015. Okay.
8 years.
Yes, sir.
When
What if you're incorporated and you have funds in a business account?
Yes. All of my investing at Equiton, and yes, I'm an investor. I don't just peddle this product. I trust it for me and my family. I do all my investments in my real estate investment corp. So the same corp that I own my properties in, I invest with Equiton. And I can take advantage of that 12.5% corporate tax rate, particularly with the residential fund. And I don't want to go down a rabbit hole of taxation because, again, I can speak for 40 minutes about that. One of the amazing characteristics of the residential fund is how favorably it's taxed. So earlier I was mentioning how, yes, you can use your TFSAs, RSPs, LIRAs, whatever you want. The residential fund is a fund where, yes, you can use all those accounts, but you don't need to be afraid to hold it in cash because of how efficiently it's taxed. If you have any questions about tax, I think it's beyond the scope of this discussion, but flip me an email, go to our website, just find out who I am, or come up to me after the call or after the talk. I'll give you my business card, and I can give you the lowdown on the tax structure. Cool.
Quick question.
Mhm.
For the cash flowing on the funds, it says monthly, right?
Yes.
So is the like 8 to 12% then divided monthly, or is it like are those two separate things going on?
Good question. So we'll walk through it, and this applies particularly to the residential fund. Remember at the beginning when I said that this investment is another tool in the investor's toolbox to get access to real estate, which by all accounts is hard to do for some people, right? So the value proposition of the residential fund is identical to that of physical real estate ownership. So when you go out and buy a duplex, right, you're going to see, and I'm simplifying here, but broadly speaking, you're going to see value generated in that duplex in two ways. You're going to see capital appreciation of the building itself. You're going to see cash flow coming from rental income from your tenants. Those are the two main sources of value. The residential fund is set up the exact same way. As those buildings appreciate in value, as dictated by those quarterly appraisals done externally, we increase the unit price of the fund to capture that capital appreciation and reflect it to our investors. While that's happening month after month, year after year, this thing's producing monthly cash flow coming directly from the rental revenue of our over 2,550 units that make up our 32 building portfolio. So it checks all of the same check marks that you going out and buying your own duplex was. The difference is you can do it in a TFSA, you can do it with 10 grand, and you're not a landlord. You can do whatever the heck you want with your free time.
Quick question over here.
Mm-hmm.
Of the
There's some over here too.
manage, how many total investors make up that fund?
We have just under 10,000 investors. So I would say 9,800 conservatively.
And how do you avoid something like the SVB happening to you guys in Silicon Valley Bank?
Great question. Everyone brings it up. So how we avoid that? It's a two-part answer. So number one, it's about how we've constructed our fund. And by how we constructed it, I mean, where do we raise our capital from? When SVB or a company like SVB goes under because there's a run on the bank,
It may not be in the best
there
interest
could
of finding
theoretically be a run on our fund,
9,999
right? Someone could come to
sell
me
a
and say, I
property
want
right now so
$600
I can
million
pay one
back.
for $1
I'll pay the early redemption
So
fee.
gating
I don't care.
funds
I want
gives
it.
us time
And
to liquidate
we
assets
may
in a
honor
more
it.
natural
We
manner,
can also
right? When
gate
you
the
sell a
fund.
$50 million
Gating the
apartment
fund
building,
means we can
they don't
refuse
sell it.
redemptions.
Right? It's not
It
above
is up to
below,
us,
you
it's
can
at our
sell
sole
in 5 days
discretion
this market,
to
right?
refuse
You can't do that with
redemptions.
this $50 million
We always
apartment
have that
building.
power.
Now, we've never gated our fund. We don't ever intend on gating our fund. Anyone that's ever made a redemption from us has gotten it back in full within 30 days, which is our mandate, by the way. We do 30-day redemptions from the 15th of the month. We've never missed one, ever. The second way that we keep stuff like that from happening is the composition of our investor base. Generally speaking, when you raise a lot of institutional capital, you're susceptible to runs like that because institutions, when they invest with you, they don't invest $10,000. They invest 50 million, 100 million, 200 million. So all it takes is 2 institutional clients or 3 to get a little scared or to change their investment mandate, whatever the case may be. And you get a few redemptions and now you're in trouble. Equiton does balancing very, very well. And by that I mean we don't raise any capital from we're not overweight in any one source of investor. So we don't have 90% of our asset base in institutional clients. We don't have 90% of our asset base in retail clients. That's people like you and me. We are relatively split evenly between retail and what we call wholesale. What is wholesale? Wholesale is essentially, we work with financial advisors. So there's going to be some high net worth investor that has a private money manager at TD, manages $2 million for this guy. This TD private wealth manager is going to look at a company like Equiton's that's never dropped in value, that offers very stable, consistent, and even increasing cash flow.
and he's going to say, shit, the bond market dropped last year. Equiton did 14%. Remember what I said about how private investments or alternatives are uncorrelated with public markets, right? They're going to go, wow, this would actually be perfect for 200 of my clients. Equiton, I'm going to buy your investment in bulk, and I'm going to distribute it to 50 of my clients. So that's what wholesaling is. So my point is we maintain a very healthy balance of institutional, wholesale, and retail clients. Now, you still, I'm talking about this at length, but it's important you guys understand this really. It's how our industry works. You might think then, well, why don't you just have 0 institutional clients, right? If they pose such a big risk to the firm, why don't you just say no to pension funds and university endowments and all these companies, insurance companies? Number one, because they raise a lot of capital very, very quickly, which is largely responsible for our growth, which honestly is better for our investors. And number two, it gives us pedigree, right? If I came to you and I'm talking about my company, and then your question to me was, well, how many institutional clients do you have? And I'm like, well, I don't have any. The reason why I don't have any, honestly, is probably because my investment isn't good enough for them, which means I've probably pitched it to some company. They've done their due diligence on me. Their legal team has reached out to my legal team. They looked at our financial statements and they didn't like what they saw. So when I tell my clients that I have institutional clients, it goes very far to give us credibility, because an insurance company, a university endowment, a pension fund, these firms can do due diligence on us far greater than any one individual could, right? So you can just trust the fact in many cases that we have institutional clients. It really does go a long way.
Question here.
Got a
Yes.
question on this side.
For the development offering like Sandstone, you said it's still open right now?
Yes.
So you guys, I assume you guys have a deadline, right? For
No,
no?
we don't have a deadline. The reason why is because we're raising 38.75. The vast majority of that equity capital is actually staked as collateral, right? And we don't need that collateral until we need our loan. We don't need our loan until we start construction, which is going to be in 2026. So the fact is, we can do a lot of the project now. Like when we file our application with the municipality, we only need like 5 or 6 million to do that. Those are what we call soft costs, right? Paying an architect, coming up with floor plans, paying municipal charges, which are not cheap, but they're not 38 million, right? And so that's what I said earlier when I said we started this project December 2022, when we submit our application, even though we haven't raised the full equity amount, right? As long as we're on the trajectory to be fully funded, that's all that really matters. And in fact, the longer, I wouldn't say the longer our investors wait, it's better for them, but you're getting exposure to the exact same investment that someone made 4 months ago. You're sharing in the returns the exact same way. So in some cases, it's actually nice to see that as well. Mm-hmm. Yes. You. Yeah.
Just wanted to know, who are you guys insured by or with?
I don't know who we're insured with. I can guarantee you that we are insured. I just don't know. Yeah. Yeah, and that's a good question. I'm not sure. Yeah. Yes.
So to confirm, if I wanted to have this in my portfolio, do I open an account with Equiton or do I have it through like a private subscription through my RBC advisor?
Good question. It depends on how you're making your investment. So if you're investing with an RRSP, a registered account, so TFSA, RRSP, LIRA, we use a custodian financial institution. So it's another bank that does allow these types of alternative investments to be held in their accounts, because RBC, TD, BMO, they won't. We use Olympia Trust, okay? So the first step in many of my investors' journeys is we'll open an account for them at Olympia Trust. Yep. And if you're investing with non-registered funds, it's a direct investment into the fund itself. There's no intermediary in Olympia. You're literally creating a bank draft and depositing it into our corporate account. All of our investors are given an online banking platform similar to what you would have with your investments. It's 2023 after all, where you can log in, you can review the market value of your investment, you can access statements, tax documents. All of this is done through the portal.
Okay, so a lot of investors are interested in cash flow. So is there a cash flow option like paying out dividends, or
Yes.
is it mostly just paid out like a lump sum at the end?
No, monthly cash flow is the main benefit of the residential fund, which is frankly my favorite investment at Equiton. Both of our funds produce an annual yield of 6%. So they both pay 6%. They both pay on a monthly basis on the 15th of every month. And you'll see that again, the overall return is higher because that accounts for the capital appreciation dictated by the appraisals. But the cash flow paid to investors every month is 6%. So every 10K invested, you're going to get approximately $50 a month. 100K, 500, so on and so forth.
And we do have a distribution reinvestment plan, so if you don't really have a want or need for that cash, we can roll that back into the fund to repurchase more units, and you'll allow that cash flow or that nest egg to snowball. And this feature we can turn off and on as your situation dictates. So if now you want to reinvest, sure, all of a sudden a year from now you have a kid, kind of need extra cash flow, we can turn off the drip. So there's flexibility there as well. Yes?
So is it 2% extra you'll get if you do it?
Yes, if you reinvest your monthly distributions, you're buying new units in the fund at a 2% discount to market value. So it's not a massive benefit, it's not going to make or break your investment, but it is a small incentive to encourage reinvestment.
Sorry, if I were to repeat that, like instead of the 6%, would it be an 8%?
No. So I'll say it this way. So let's say you do a 10K investment, so we pay out 6% annually, every month, that's $50. So let's say you're buying new units at, let's say the market price is $10 per unit. You're not going to buy new units at $10 per unit. You're going to buy new units at $9.98, which is a 2% discount. So we're going to issue you fractional shares additionally. Mm-hmm. Any other questions? Yes.
So I have an RSP with like Sunlight, for example. So how does it work? Like, do I need to take that money out, pay the taxes on it, and then transfer it to
No.
Olympus?
So it's a transfer. So you're not doing a redemption of your RSP, so it's not triggering any taxable event. It's the same as you within that RSP, you're selling one investment and buying another one, but the capital never leaves the RSP. So we would do a transfer from one to the other. And honestly, everything is done by your associate at Equiton. So when I do investments for my clients, first of all, I'm their dedicated associate. They don't speak to anyone else at Equiton except for me. And I'm opening their accounts for them at Olympia. I'm requesting transfers from Manulife or Sun Life or wherever that is to Olympia Trust. I'm conducting their investment purchase. It's not like we just give you a bunch of paperwork and you're on your own. So we actually handhold our clients through every step. Mm-hmm. Yes?
Earlier you said you don't sell any properties. How exactly do you make money off that? Like without selling properties?
So we would sell properties.
Okay.
When I said we haven't yet, well, we haven't yet, but really what I was trying to say is it's not a source of profit for us. Like our thesis is not to make money when we sell properties, right? We're making money on a small percentage of the assets under management. So when our buildings generate X amount of return, we're going to take a small percentage of it, and then we pay the rest to our investors. But all of the returns that you guys are going to see on our website or on the marketing material I brought, that's all net of fees. These are the returns our investors receive at the end of the day. So when I say the residential fund pays 6%, our investors receive 6%. The fact is we make a little more than that. We take the delta, we give the rest to our investors. Mm-hmm. Yes?
Does Equiton assume any transfer fees?
No, all transfer fees are borne by the investor. It can be sometimes a deciding factor in not doing an investment, particularly at smaller amounts. So I've had actually a client about a month ago wanted to do a 5K investment in a TFSA, right? To open up an Olympia Trust TFSA account costs money. To do a transfer, it's going to cost money. And I flat out told the woman, like, it's not worth it. Like the first 5 months of your investment are just going to go back to paying fees. And we don't want to be in a situation where that's the case because it's a bad experience for you as an investor. You're going to end up pulling out, and it's a bad experience for us as well. So if we can just avoid the situation altogether, we generally try and do so. Generally speaking, if you're going to be doing a minimum investment like 5K, we do many of them, but I would recommend doing it non-registered. And the reason why is because there's no fees. It's not that there are low fees, there's none. Right? It's just much more approachable.
So what's a good minimum for a registered account?
I've done the math. I think it's worth it at 10K. But it's more than that because every investor is different. I'll give you an example. Someone comes to me and says, look, I'm young, I don't have a lot of money today, but I was inspired by your talk. I know I want to be in real estate. My grandfather was in real estate. I want to follow suit. I don't have a lot today, but I have 5K. But I want to continue to grow this over time. This is going to be the first of many investments for me. Then I'm happy to have that individual pay that higher fee up front because I know over a 7-year period, that extra $100 they spent at year 1 does not mean very much. Right? If you came to me today and said, I'm going to do 5K, but I'm telling you now, Lawrence, that's all I'm going to do with you. I'd say do it in cash or don't bother because the fees aren't worth it. Right? So every investor is different. Any other questions, guys?
Okay, I would say okay.
So you guys are getting quarterly appraisals on the 32
Yes.
properties that you guys have?
Yes.
It feels like a waste of money to me.
It's not a waste of money. So the way it works is, and I'll explain why.
Like I'm just like I know that if like if you're
Tell him
saying
how to run his business.
yeah, like if the value of real estate doesn't fluctuate, from
But
year
it
to year,
does. And the reason why, I'll explain something. So when you buy a property, like a bungalow, the value of that building is largely determined by speculation, right? Someone is going to buy it from you and they're going to speculate as to what that property's worth. It's speculation in the sense that when we buy a property, when I buy an apartment building, it's valued fundamentally as a function of the revenues it's generating. It's valued as a business. I'm only going to pay $50 million for an apartment building insofar as it's going to generate me $3 million of annual recurring revenue, ARR, right? Now, that is an important implication because if I can increase that 3 million of ARR to 3.2 million, either by putting in more efficient light bulbs and appliances or renovating and increasing rent or doing a combination of those two things, well, this building is now worth more, right? Would you not pay more for a business that gave you 3.2 million instead of 3? Of course you would. So that value increase needs to be reflected. The mechanics of how apartment buildings and other institutional real estate, the mechanics of how they're valued isn't the same as a single family home because we can drive value agnostic of how the broader market performs. And that's why we did so well last year, right? We did 14% when the broader market was down. How did we do that? We engineered it, right? We turned over tenants, we modernized units, we cut expenses. We put in additional units where there used to be common space, right? It's part of why the strategy works so well.
Okay.
Anyone else?
Let's talk about getting started. So, you know, if someone's interested, they feel like, okay, maybe this is something that I want to do. What are the next steps that they would take?
You guys kind of said it at the beginning. Your job here is to educate. I always fancy myself an educator. So any single person that's invested with me, unless they're extremely savvy, they've done like 4 of these before, then I literally just send them the paperwork. But 99% of my calls with clients, they're 1-hour educational calls, right? Where we discuss a lot of the things we discussed today. Why private investing is even a good idea, the difference between publics versus privates, real estate in general, why we're bullish on it, why there's some caveats, the investment landscape at Equiton, breakdown of everything, right? Then we do a Q&A, and only then do we move forward, if and when we even get there. And sometimes we don't, and that's okay too. But in every case, it's educational for my clients.
Okay. And no other questions. Okay, so yeah, we really appreciate you guys coming out. We started later than expected. There was crazy traffic today. Everybody got hit by it.
Yeah, definitely.
But yeah, one thing that we always like to do at the end of the events, we like to do a survey, just to kind of find out more about you, more about what you thought about it. So first thing, we'll start out with name, phone number, email. If you don't have a pen, if you don't have a paper, just put your hand up and we'll get you one.
Where's Macario?
How late did we go? What time is it?
It's only 9 o'clock.
Oh, wow. I wonder what the Leafs are doing.
Oh yeah, that's a great question.
Oh. I'm also afraid to ask.
Just never know, huh?
Okay, so next up, how would you rate the event overall? Like, don't be scared to give us a bad number. We're all grown. We can handle it.
I don't know if I would take that.
I take offense to it.
And then the next thing, was this topic valuable? Did you get a lot from it? On a scale of 1 to 5, what do you think?
The real estate action.
The real estate action plan. We're gonna get to that. So next up is what other topics do you want us to cover in the future? I know some people have said pre-construction, so we might be having a pre-construction one coming up. But just anything that you want to know about real estate, you can put that in there. So then, the real estate action plan. So what is the real estate action plan? This is basically where you sit down with me or you sit down with Safraz. It usually takes about 20 minutes. And we basically find out, like, okay, what are your short-term goals? What are your long-term goals? What does your current portfolio look like? What do you want it to look like? And then really, like, what is your big why? And sometimes we're able to help. And the truth is, like, we're not always able to help. But the first step is to have that phone call and then we go forward from there. So if that's something that you're interested in, just circle yes. And then the last one, what's the best time for you? Morning, afternoon, evening. And then before we wrap it up, we do appreciate everybody coming out. We got some Blanca estates for you, some Safraz estates for you. You can grab it on the way out. And we want to give a shout out to Mike in the back. So people always ask, like, is this your wine? Are you guys like stomping on the grapes?
We're
no,
crushing
we don't. We don't stomp the grapes. He's the owner of Vinbon in Richmond Hill, and he's the one teaching us about wine and helping us with the wine at all the events. So we appreciate that. Also, Charles at the back, if you could just put your hand up. So that's, you guys might have seen him at the first event, but this is our trusted mortgage broker. He's investor focused. He's always there to help. So if you have any questions for him, he'll be outside as well. But we appreciate everybody coming out and look forward to more of these in the future. Okay. Lawrence,
So hot. Thank you guys, man.
Lawrence, appreciate you. Thank you so much.